So what we've seen is that we have changed the attributes of the asset classes. In the past, we always look for fixed income for yield and for equity and stability and equity for risk. And now you have that equity is the yield and fixed income has become the safe haven component. So we really are in an abnormal marketplace in terms of the assets and their contribution. What is interesting is that the best performing strategies for 2016 so far has been equal weights of fixed income and equity. But that also shows you that both of them are at a maximum to some extent, but the equity far more so than fixed income, interestingly enough. Because if you look at the dynamics of fixed income, there is a component of risk and there's a component of inflation. Inflation remains very low. I don't see anything in terms of the world increasing the burden on having a premium on inflation. So I think in case of the US fixed income market, it will continue to grind lower. It's probably already, for the year, I think fixed income in the US has paid about 12 to 15% return. But there's more in it because simply the impulses from around the world, the CNY, the Chinese currency devaluation, is deflationary because, of course, China buys competitiveness by lowering the relative prices. And when those prices goes back into the world scene, it is at a lower price. You can even say to a large extent that the reason that the Americans have been able to maintain a relatively high disposable income is because they've imported cheaper and cheaper Chinese goods to substitute American products. That in itself has created inequality, less job, and a rise of Trump. But that is the cycle we're in. We are the late cycle of that. But having said that, I think clearly we need to see both fixed income and equity, if you look on a 24, 36 months horizon, will underperform. And I think what stands out is my always go-to theme is that you want tangible assets, you want businesses, you got good management. So I think we will gravitate towards the sectors that is underperforming, emerging market, mining, and IT technology, because technology will be the driver of growth. In a world with no productivity, technology can unleash that. The best example, just coming back from China, is that China runs productivity at 20% of the US levels. So right now people are saying, oh, the biggest problem with China is that we have a lot of debt, is unsustainable. Oh, hang on a minute. It is unsustainable at zero productivity or low productivity. But if you ramp up the productivity across all the geographic region in China from 20% to 40 to 60 to 80% of the US, you're going to have a massive boost of growth, not coming from the credit side, but coming from doing things cheaper, smarter, and better. And that's interesting enough what is happening for China. A city like Shenzhen has become the Silicon Valley of Asia. You have all of the big Asian players now situating themselves there on the backbone of what used to be a manufacturing infrastructure. Now it's a technology infrastructure. That infrastructure will then migrate into the rest of China. So I think there are very, very, very significant improvement in technology, demographic, infrastructure, education as investment themes going forward. And that in itself, all these sectors had huge amounts of productivity relatively to what you just stated: equity, traditional equity, service-based equity, banking systems, zero productivity. Real estate, which is a big, big play in most of the emerging market and in Australia as an asset class, they will have to underperform because you have to remember, real estate will pay you exactly inflation over time. So you may think you're the smartest apartment selector in the world and you are the best real estate investor, but you are really just playing on the law of the big numbers, that inflation has been coming down, interest rate has been coming down, disposable income has been relatively stable, meaning that the price has gone up. They will gravitate towards the long-term inflation rate over time.